Today, Bitcoin dips back below $27,000. A crypto-related bill meant to intercept a future U.S. central bank digital currency advances. And Solidus Labs' Chen Arad breaks down the crypto security startup's new report on market manipulation. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Crypto prices in the red one day after the Federal Reserve's plan to keep interest rates at higher levels for longer. As of noon Eastern, Bitcoin slipped to around $26,500, Ether fell slightly to under the $1,600 mark, and XRP edged lower as well to 51 cents. The Fed deciding in its policy meeting to hold rates steady for now, but also indicating it expects one more rate hike before year-end and fewer cuts than initially thought in 2024. Okay, let's talk about the top stories. Tether has resumed lending out its own stablecoins less than a year after it said it would reduce its secured loans to zero in 2023. That's according to the Wall Street Journal, which noted that the stablecoin issuer's latest quarterly financial update includes about $5.5 billion of loans as of June 30th, up from $5.3 billion in the prior quarter. Tether Holdings confirmed to the Journal that it made new loans. We reached out to Tether, but didn't hear back right away. The spokesperson reportedly said that the company's goal is to prevent any significant depletion of customer liquidity or the need for them to sell their collateral at potentially unfavorable prices, which could result in losses. Tether, which is incorporated in the British Virgin Islands, notoriously does not publish audited financial statements or a complete balance sheet, which makes for an incomplete picture of the company's financial health. Next, the now-defunct crypto exchange Mt. Gox has pushed its repayment deadline by a year. Creditors of the Japan-based exchange, which went offline in 2014, are still waiting to get repaid billions of dollars worth of Bitcoin. According to Mt. Gox trustees, the deadline is now October 31st, 2024. Mt. Gox, which was once the world's largest Bitcoin trading exchange, went bankrupt in 2014 after a massive hack, which led to hundreds of thousands of Bitcoin being stolen. CoinDesk reported that Mt. Gox was able to recover about 20% of the stolen tokens. And finally, a bill meant to restrain a future U.S. CBDC, or central bank digital currency, is heading for consideration on the House floor following yesterday's committee approval. The move marks more progress for crypto legislation in Congress. Republicans in the House Financial Services Committee cleared the bill that Patrick McHenry, the committee's chairman, said, quote, protects Americans' privacy and our financial system from the risks a CBDC would pose. According to lawmakers, the CBDC Anti-Surveillance State Act prevents the Fed from issuing a CBDC to individuals, ensuring it couldn't mobilize into a retail bank able to collect personal financial information. The legislation also states that the Fed and the U.S. Treasury lack the authority to issue a CBDC without congressional authorization. All right, for our main story, Solidus Labs, a company focused on risk monitoring for digital assets, recently released part 2 of its crypto market manipulation report series. This one focuses on wash trades. Crypto World's Talia Kaplan spoke with Chen Arad, the firm's chief external affairs officer, about what was uncovered. He also breaks down exactly what this form of market manipulation is and how it can be prevented.
The second installment of your crypto market manipulation report just dropped last week, revealing $2 billion worth of wash trades on decentralized exchanges since 2020. For those who don't know, according to Solidus Labs, crypto wash trading is when one entity executes both sides of a trade, so buying and selling a cryptocurrency or NFT. When this happens many times, it can mislead investors into believing that the trading volume and market value of a token is higher than it actually is. Now, the new report provides data and specific examples of the main types of wash trading methods used by scammers. Can you take us through some of that data? What stood out to you?
Yeah, absolutely. Let's start with some of the headlines in numbers. You referred to some of them, Talia. We identified, looking at around 30,000 liquidity pools in Ethereum-based decentralized exchanges, we identified about $2 billion worth of wash trading, beginning in September 2020. So, we looked at data from a few years, to kind of give a few reference points. About 67% of the liquidity pools that we looked at had evidence of wash trading in it. And in total, about 13% of the volume of all of those liquidity pools together. It's important to say this is a sample. 30,000 liquidity pools is a small percentage of all the liquidity pools out there. So this is a sample meant to do a couple of things. A, just to demonstrate that wash trading can and does in fact exist in decentralized exchanges. There's a bit of a tendency sometimes to assume or to argue or to claim that because it's on a blockchain, because it's transparent, because there are fees that make it less cheap, basically, to do a wash trading on decentralized exchanges, then it doesn't happen. It's clearly not true. And beyond that, to also show how people actually do it. So to define what wash trading is on decentralized exchanges. And we provide a number of examples. I'm sure we'll get to them.
We sure will. One case study in your report, a group of connected wallets that Solidus Labs said facilitated the wash trading of a meme token called Shiba Farm to collect a profit of more than $2 million. Can you break down how this was carried out?
Mid 2021, when that token was introduced, kind of found its way to the web, and immediately, it was important to say it was a hard-coded rug pull, meaning in the smart contract itself, there were elements that basically meant that you could invest in that token, but you would not be able to withdraw the funds. Now, once you deploy a token like that, how do you get people to invest in it? You need to make it look real. Wash trading is a great way for scammers to do that. And that's, we believe, one of the main incentives. With the Shiba Farm example, you can see that the moment a number of wallets started trading between them, and in that case, it also became more sophisticated than that. New wallets were opened that are linked through the transactions to the original wallet, and started executing each a number of trades. About 80 to 400 Ethereum was deposited to each of these wallets, and each of them started to execute trades essentially with Ethereum against Shiba Farm. That's the liquidity. That's the liquidity pair in this case of around 5 to 20 ETH, and you can see the money moving between those wallets again, back and forth, which is how we know that they're associated with the original deployer. Ultimately, let's kind of cut to the chase here. In a span of about 2 hours, around $2 million were wash traded, and we can also see that during that 2 hours, around 50 other unrelated wallets invested in the tokens, meaning there are around 50 wallets who were affected or essentially victims of this wash trading. Just a very kind of a great example of how fast these things can happen and how easy it is to miss. And it's also what an effective way it is to attract interest to a token that has no actual value. All of that happened without any actual real investment in that token.
The report finds that wash trading is one of the most common but preventable forms of market manipulation when it comes to DeFi. Can you take us through some of the ways crypto wash trading can be prevented?
Yes. So first of all, the first step with any form of market abuse is to raise awareness around it. And that's what we're trying to do with these reports. As long as, there's the sentiment in the DeFi space that it doesn't happen, that it can't happen, then, it's easier to do because people are not looking for it. We do believe, obviously, because we looked at a small sample that, there's much more of it in the entire space. But, this doesn't necessarily reflect, to all liquidity pools. We just wanted to point out that it's a very large problem in one place. We often find ourselves in the position where, as a company that's deeply committed to enabling the potential of crypto and DeFi by mitigating these sort of risks, we sometimes have to point out negative things about our own industry. We never enjoy it, but sunlight is the best disinfectant, as you might be able to see. My T-shirt says, you have to be able to define the bad in order to highlight what is good, put a line in the sand between healthy markets with healthy volumes and those that are not healthy, and help begin to solve this. How can it be prevented? I mean, you can see here the kind of hallmark of a market abuse in DeFi. It's in some ways it's easier to do this sort of stuff in a market that is decentralized because it's permissionless. Anyone can deploy a token. Anyone can open new wallets in a sophisticated way that makes it hard to detect. But you can also see the opportunity when it comes to risk monitoring. It's all transparent. All of this is public data, and using the right tools, looking at it the right way, you can you can actually identify it, without necessarily having to issue subpoenas or investigate using private data. So that's part of what we're trying to do with this report, raising awareness. We also are working on providing some publicly available dashboards so that people, anyone could examine various liquidity pools before they decide to engage with them. That's you can expect that to come soon from us. And also, there's obviously, over time, we also believe, just like, there used to be more market abuse in centralized crypto exchanges. If you look 4 or 5 years ago, the centralized exchanges worked very hard. And today the numbers are much lower. Regulation kicked in. We believe here as well, ultimately, regulators are going to step in to some degree, create some, guardrails. And as a community, we'll continue raising standards. We're obviously working with a lot of decentralized exchanges and the community at large in order to prevent this. So when we say preventable, what we mean is it's on the blockchain, it's identifiable by raising awareness, by improving tools and using them, providing public tools, and by the community working together, we can actually help clean those markets.
Arad also discusses crypto sentiment abroad and weighs in on regulatory advancements here in the US. You'll be able to check out his full interview on cnbc.com/cryptoworld. Okay, that's all for today, but we'll be back again tomorrow, and we'll see you then.